Abby, reaffirm this morning why we need to participate in the stock market given the sum of all our fears.
Tom, well, good morning to you, and thank you for inviting me to be here today. What we know about the stock market over a long period of time is that if you have confidence in the economic outlook, equities are usually the best place to be. And clearly that has been the case now for an extended period. And I think that one of the important things for investors to think about now is valuation. You want to participate in equities, but you want to make sure that you're doing it at the right price. And one of the things that you and your colleagues have spoken about very clearly already this morning is that interest rates may be becoming less friendly than they have been towards valuation. When we look at the valuation models that are used by so many investors and so many analysts, including those at Goldman Sachs, there's this general sense that the market is roughly at fair value. And that sounds like, not bad. If you believe that this will in fact be a protracted economic recovery and then expansion, not a bad thing. However, we're sort of on a knife's edge. The valuation becomes less appealing if interest rates rise. My colleague, David Costin, who does this specific forecast, has been saying for a while now that he thinks that fair value for the S&P 500 this year is 4,300, which is pretty much where we are. One more point, and that is when you're at fair value, there's no margin for error. If there are disappointments, be it on interest rates, the disappointment on OPEC, for example, over the last few days, that's where you start to see a big increase in volatility within the market itself.
So many would say, Abby Joseph Cohen, that none of what we're living right now was in your economic textbooks at Cornell a few years ago. For example, and I do this for my colleague John Farrow, how do you respond to the confidence to invest given this colossally odd negative real yield?
Great question that we're asking ourselves as well, Tom. And the answer is carefully, very carefully. We are in an unprecedented period, both with regard to an extended length of time for these negative real yields. By the way, there have been negative real yields in Europe now for quite a period of time. And we are also in an unusual period with regard to nominal interest rates. So when we run our models, we're looking at both those nominal and real yields and recognize that we truly are in uncharted territory. So let me say one more thing as somebody who used to be a quantitative analyst. I like to say I'm a reformed quant. I use these models as a starting point. I don't use them as gospel. I use them to give me some direction. Are we undervalued, fairly valued, overvalued? And then once we have that general sense of direction, what could go wrong? And what could go right? And as we take a look at things now, the things that could go wrong include commodity prices. We've seen what OPEC has done. This, by the way, could be more of a problem for markets outside the United States. In the U.S., commodity prices are actually a fairly small component of our total cost. The second thing that I'm perhaps even more worried about has to do with public health. We've had these incredible vaccines, extraordinarily effective, and now we're sort of bumping into problems with regard to distribution. In the United States, we think this will be a regional issue rather than nationwide. Yeah. But when we take a look at the reopening of places like Europe, this is much more problematic. The distribution in Europe of their mRNA vaccines really has been lagging. It's one of the reasons that the GDP expectation in Europe, continental Europe, is below what we would have liked to see.
And John, you've absolutely nailed that on world travel or the lack thereof.
Well, the airlines have suffered because of that, Tom. And a cyclical story in many ways, sector to sector. The airlines have peaked. In the minds of some people, they're struggling now. The banks are starting to struggle a little bit as well over the last month. Abby, what was interesting in your response to Tom is that you turned to your process. And for the following question, I'm less interested in the call and far more interested in the process. The debate right now on the cyclicals is the debate it's always been over the last 6 months. Is it just a short-term reopening trade or something more durable, something more sustainable? What is your process to distinguish between the two things? What are the signposts you look for?
Well, we're also looking at the idiosyncratic opportunities because just because a particular company happens to be in a particular sector or industry, according to the S&P definition, doesn't tell us as much as we need to know. So we're really looking at how individual companies have positioned and or repositioned themselves. I happen to believe that there will be a movement ahead in capex. We think there will be an infrastructure bill of some sort. Obviously, we're not privy to the negotiations now in the Congress. We think there's a desperate need for spending on infrastructure, but there's also a need for private engagement in capex. One of the things that we have seen in the last decade or so has been this decline in the use of corporate cash flow for these purposes. We have seen much more of it than usual go into things like dividend payment and share repurchases. Those dividend payments may continue to increase, but if you are a corporate CFO and you look at your current share price, you say, do I really want to be repurchasing at these levels? And that's one thing that, in addition to the need to expand physical capacity, may in fact lead to improvements in capex. So the short answer to your question, John, is we do think that there will be a movement towards some of the industrials, and let's recognize that industrials are all over the lot, and we need to look at the international trade aspects of this. Some of the companies that have repositioned themselves well for the 21st century needs, including things like renewable energy, more efficient processes, the use of improved metallurgy, and so on. Some of these are U.S. companies. Some of them are outside the United States, but are important suppliers to U.S. companies.
Do you think that the impetus, though, for some of that capex spending and the potential for that to finally sort of maybe get back to levels that we saw in previous generations, that's going to come completely at the behest of these companies, or do you need a little bit more government involvement to sort of move this along, Abby?
Yeah, well, let me be careful when I discuss the numbers here, because I don't think we're going back to where we were 20 years ago as a percentage of the total use of cash flow, because of the change in the composition of the S&P 500. We now have so many more service-oriented companies that are not heavy-duty industrial spenders. So we need to be looking at things industry by industry. So I do think that there will be a movement back towards more capex. The thing that worries me most about government spending has been the significant de-emphasis of spending on things by the government that corporations don't usually spend on. And let me be more specific. And that is over the last several decades, in fact, going back to 1860, the US government has been one of the major investors in long-term basic research. And what we have seen over the last 20 years has been a decline in basic research spending as a percentage of the federal budget. I think this is a mistake. We have to keep in mind, for example, that those terrific mRNA vaccines that we all are so happy to have now, that initial research was done by spending given by the NIH 10, 15 years ago. We forget...
Abby, you get that call. It's going to be David Costin.
That's David Costin.
David's very worried you might make a call, because David Costin right now is 4,300 year-end, TK, and we couldn't be more bored by that. Right now we're at 43, 42.
I have to tell you that was my granddaughter calling.
What did she say?
It's her 6th birthday today.
Oh.
So,
Abby, why don't you just take the call?
Abby,
just take the call.
Abby, take the call, please.
Just say hello. Say happy birthday.
I will call her in just a minute.
We're going to let you go, Abby. It's good to catch up. We think this is more important. You want to make a more important point than saying happy birthday?
I'm going to sing happy birthday to her, and you don't want to hear my voice. So basically, the federal government has been the basic provider of funds for research, but also for infrastructure. And we have seen a notable decline in that over the last 20 years. We just need to get back to where we were. And that would be extraordinarily helpful for long-term economic growth.